Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior Podcast. Our goal with this podcast is to sit down with top market practitioners, learn about their experiences in the financial industry, understand more about the tools and techniques, the systems, the routines that they use to evaluate market conditions, and get a sense of what they're seeing and thinking about the current market environment. Sort of a unique and interesting guest today, Steven Bavaria. Steve's the author of the book, The Income Factory. Most of my guests, we talk about price, right? As a technical analyst, I was trained to analyze price action, to look for patterns and signals in price, to focus on the information the markets provide back to us in the form of price action. As you'll see from my conversation, as you'll hear as I discuss Steve's book with him, it's less, in his opinion, less about price. It's less about capital growth or capital appreciation. It's more about income. It's more about the income component and having consistent streams of income. We'll talk about loans and bonds and high yield debt and other areas using closed-end funds and other structures that he has, designed ways to create your own income factory. This conversation really made me think, and I hope you enjoy it as well. Please enjoy this conversation with Steven Bavaria. I'm super excited to be sitting down today with Steven Bavaria. Steve's the author of The Income Factory, also the publisher of the investor group Inside the Income Factory on Seeking Alpha. Steve, it's really good to meet you virtually. I've looked into your work. I'm super impressed by how you're approaching income investing. And thanks for giving us some time today.
Thank you, Dave. It's a pleasure to be with you.
So you have had a pretty good career in the financial industry. This is sort of like the latest chapter in I think, your time in the industry. Can you talk a little bit about your journey to income investing, right? Before you wrote the book that we're going to be talking a little bit about, what were some of those formative experiences for you in the industry as an investor that kind of aimed you to this particular point?
Sure. Well, I started out as a banker 50 years ago or so after I got out of college, back when banking involved credit as it does now. I found myself in the international department of the Bank of Boston, the old First National Bank of Boston, and kind of became a troubleshooter chasing bad loans, corporate loans around the world. So I learned a lot about credit and especially how it can go wrong sometimes, and got involved in collecting it. So I ended up moving to Australia to run the it was a subsidiary out there for a few years that had a lot of credit problems. Mm-hmm. And then that worked out pretty well. And I moved to Panama and did the same thing there, chasing bad loans. It's always helpful to have other people screw up before you in a job, because then whatever you do, you look better. And so then I came back to the bank in Boston, and I did some other things within the bank. But the most fun times I had were actually when I was more junior, running around the world.
Yeah.
Then I left that after about almost 20 years in banking, and I was living in New York at the time and went back to school and studied journalism because I had always loved writing. And so I became kind of a cub reporter in my early 40s. I was this cub reporter for a magazine called Investment Dealer's Digest in New York that covered the financial business. And so I did that for a few years, and I learned a lot about credit. I covered the private placement market, which was good training and background for what has now become the private credit market. But for generations, insurance companies and pension funds and other private institutions would make their own loans or issue bonds for companies without a banker being involved in it. Yeah, and they were called private placements, and it was a huge market. And some of the big players like Mass Mutual and New York Life and others, their names now pop up as the sponsors or managers of all kinds of new entities like business development companies, BDCs, and mutual funds, especially closed-end funds. So it gives me a certain insight into the kinds of securities that are now being sold to retail players, but that have been around for years. And it gives me a certain confidence, at least in some of these names that have been doing it for 30, 40, 50, 60 years.
Yeah.
That even if there are a lot of negatives in the market, sometimes people get stressed out. People like to write sky is falling articles. An article that says the sky is falling always gets more clicks or reads, and editors like it better than an article that says, well, the sky's kind of gloomy, but it probably won't fall. So we see that all the time, that you'll see far more articles out there about things going to hell than about, maybe we'll have some challenges, but we'll get through it. We'll muddle through it. And a lot of my investing. So some of my ideas about investing and what I've been, doing, the writing, I had to practice as a journalist, and then I learned about credit as a banker. And then I finished up after, for my last 15 years or so, I worked in the credit rating business with Standard & Poor's primarily. And when I got into that, I didn't know what I'd be doing, but I needed a job. And I was in the right place at the right time. And I'll never forget, I went to a conference where there was a guy named Jimmy Lee, who later became vice chairman of JP Morgan, but he was with Chemical Bank, which eventually became JP Morgan. And he was the guy who more than anyone started the syndicated loan business, or really made it a big business, underwriting corporate loans, which are now done in the billions.
Yep.
And I went to a conference one day, and this was back when banks did their own credit work, and there was no rating of bank loans because they weren't publicly sold yet.
Yeah.
But they were starting to be, and they were starting to be put into these securitized vehicles, like these collateralized loan obligations that were started 30 some years ago, and now are being brought into the retail market through closed-end funds and ETFs. And there was somebody asked Jimmy, he was on a panel, and they asked him, "Hey Jimmy, how do you price your loans?" And he was a real wise guy. He was brilliant, but he was a real wise guy. I wrote an article about this in Seeking Alpha some years ago, but he answered the question, how do you price your loans? He said, "Oh, we price them all the same, 400 basis points over LIBOR," which they used back then.
Yeah.
And everybody laughed, and then the panel ended and we all went home. And I sat there in the room thinking, he's not kidding. I mean, sure, they make, bankers are taught, do we make the loan or don't we make it? Are we going to get our money back or not get our money back? They don't think about, well, do we price it as a double B or a triple B, and who's going to buy it, and how, they weren't into pricing, and because they weren't into pricing and trading, and those things didn't matter so much. Do we put it on our books or not? Yeah. And that's what he was saying, that they still pretty much, okay, maybe some loans are at 425 over LIBOR and others are at 375, but they don't spend much time worrying about that. And I walked out thinking, holy, what? This guy's given me, we should be rating these things, because some loans are probably almost investment grade, then triple B minus, triple B. Others are triple C. You've got hundreds of basis points difference in the quality of the risk. And, somebody's leaving money on the table, either the lender or the buyer, on all these deals. And it's a huge business to rate these things. So I came back to Standard & Poor's, hey, I got a new good idea for you. It took me a year and a half to convince people that we should actually start doing this. And I don't blame them for being slow, because at the time, all they ever did was rate, will a company go bust or not? Yeah. What we call default risk. Will it default or not? But they never rated for public bonds or anything like that. Well, if you have security on the deal and it goes bust, will you get your money back or not? There was a whole different dimension to bank loans, corporate bank loans, that you didn't have with unsecured bonds. So you could have the equivalent of like a triple C company in terms of its default risk, but where you tied them up so well with covenants and collateral and everything that it became the equivalent of a triple B risk. Yeah. And so we had to come up with a whole new set of criteria to not only match up with our default criteria of, will this borrower go bust, But
Right.
if you do, how is your packet? How is your deal packaged, and what's the collateral and everything? So I got involved in all that, and we put it all together. And the rest is history. They started rating these things, and at the same time, other people in the market were doing things to help make loans a more sort of a more public sort of risk. And that essentially was my career. And then I retired until I started doing my own investing, my IRA rollovers and stuff.
Yeah.
And then I began to realize, this kind of gets me into where we are here. I began to realize that you have an alternative to just investing in stocks. Even if you buy into John Bogle and a whole bunch of Nobel Prize winners who will tell you that, some of you might be able to beat the average, but we all can't beat the average. And, even if you know how to beat the average with your stock picking system or whatever you got, once you start selling it to millions of other people or hundreds of thousands, whatever, they're not all going to beat the average, or it wouldn't be called the average. And that, in fact,
although we all think we're above average, Steve.
in some ways we are, yeah. But so I found out as an investor of my own money that, it's hard. Even if you follow John Bogle or whoever and you just buy an index fund and then you're Rip Van Winkle and you sit there and forget about it for years, that's probably the ideal way to invest long term. If you can get the equity historical average, total return of whatever it is, 9-10% year after year after year,
not bad,
and double and redouble your money every 8 years or so, for 40 years. I mean, you're really going to be you're going to do better than the average investor who tries to beat the average, because most of them will end up hedging, they'll be taking more risks. So they'll have to hedge some of it with lower earning assets and everything else. And you put it all together and they're lucky if they're successful to even meet on their whole portfolio, the hedged parts and everything else, a 9 or 10%. So I began to realize, because I knew about credit, and I knew that with high yielding credit, if you can earn 9% or so in interest, you don't care about capital gains, but you're getting that year after year after year and reinvesting it. Right. Versus if you do an index fund with the S&P 500, for example, what are you betting on? The dividend's only about 1.5% on the SPY or the S&P 500. So you're counting on another 7 or 8% in capital gains average every year in order to get your 9 to 10%. Whereas, if I can do that and because of my credit background, I knew you could see. So I would bring in a different orientation.
Yeah.
If I can invest.
It's interesting, Steve, because it makes sense now that I've sort of looked into your book and your work. It makes sense, given your credit background, a much greater appreciation for the income components and outside of the equity space and just the ways you can generate income. Was your inspiration to write The Income Factory, was that based on your own investing experience and trying to create a portfolio with those sort of structures?
Yeah. I mean, I started out, I guess you would call me originally, if you go back 15 years or so, I was probably what you would call a dividend growth investor, that DGI, where you're investing in a portfolio and maybe you're doing it with a few more utilities and other funds that might even have higher yields. A higher yield in a stock is generally 4 or 5%. If it gets up into the 7 or 8%, unless it's an MLP or some sort of unusual type of equity, it's usually a signal that there's something wrong with the company and the market's pricing the yield up because they expect the price is going to drop, or
the price of the stock has tanked so much that all of a sudden your yield looks way better than it was before. Right?
Or the dividend is in danger.
Yes.
So generally I was probably doing dividend growth investing, where the idea is, okay, I'm going to get maybe 3, 4, or 5% in my cash dividend. So I only need to get 3 or 4% more, and I'm still up to 8, 9%.
Yep.
And then I realized, okay, well, that's cool. But then I began to realize, and especially if some of you're not just buying stocks that are high yielding. You've got more typical index type stocks in there where you might be getting your 1 or 2%.
Right.
And I began to realize, even with an index type or with that John Bogle sort of approach, the Vanguard, guy who invented indexing, it's still hard during a tough year when markets are going down, and then all you're getting is your 1.5 or 2%, and meanwhile it's drifting down, or not so drifting, it's plummeting, whatever.
Yeah.
That's where I found, okay, if I were invested in credit, high yield, senior loans, and then there are other things you can get into. Well, BDCs, or I didn't know a lot about them from my early days, where you can get your 8, 9, even 10% or more with certain kinds of, with closed-end funds where you get a little leverage along with it, which pumps up your yield.
Yeah.
You can get that year after year after year, reinvest it if you're in a reinvestment mode, like you haven't retired yet. But even after you retire, if you're 60, 65 and you're retiring, you may live to be 90. So you've still got to have a growth
need income. Right?
So you've still got to leave some of your return in there to reinvest and compound. So I began to realize that, hell, I can sleep a heck of a lot better if there's a market that's not so great. It may not be great for credit either in terms of market price, and it hasn't been these last few months, as you know.
Right.
But if you're collecting 9, 10%, and if when the market's down, you're actually reinvesting at a higher rate because you're getting the same income basically, and now reinvesting it at lower prices. So now maybe I'm currently getting around 12% on my portfolio.
Right.
So, but it's down. If I look at my total return, it's down, but at least I'm making 12% and reinvesting it and compounding it, or most of it. I have to take a required minimum distribution out of my IRA now and everything. But the point is, and if I were 10 years younger or 15, 20 years younger, I'd be reinvesting the whole thing, building a retirement portfolio. So it's just so much more comforting to know that even if my market price is, moving around a lot or has gone down, I'm building my income stream at a steady pace. And if I'm into economics, I majored in that years ago. And there's a guy named John Burr Williams who, back when, Graham and Dodd were writing their stuff in the 30s, coming up with the traditional approach to corporate investing that we still use. John Burr Williams was writing sort of the other complementary piece to it, where he was demonstrating that the market price of something in a totally efficient market is actually the discounted present value of all the anticipated future revenue it's going to generate, future cash flow. Now that can move around because you're going to discount it at different rates for different risk, periods. I mean, it's not a perfect science, but that's the way I feel. If I'm building my income steadily at a rate that's actually going to double it every 8, 9, 10 years, then unless the market's totally irrational, at some point the market's going to reflect that growth of income over the long term.
So Steven, it makes sense so to summarize, it seems like instead of focusing on like a dividend growth approach, I'm looking for capital appreciation. I want the price to go up, but I'm also looking at the dividend payment, like the income component. I'm trying to marry the two. And you're basically arguing focus less on the capital appreciation, just focus on the income stream and make it more consistent. So can you give us just sort of a high level, what would a structure of an income factory type of portfolio look like? Would it be primarily through closed-end funds that you would be getting this exposure? Or what would that structure look like, again, at a high level?
Yeah, and let me first say that there are two of me that talk about all this, that in theory, the idea that math is math, so to speak, and that you can achieve, let's say, a 10% total return, either through 0% yields and 10% growth, or 10% yields and 0% growth, and that and anything in between, 5% and 5%, that it's all the total return is all that valuable, whether you get it in cash or not. And then it's up to you.
Sure.
If you want to grow it and grow your compound annual growth rate, which is a different but similar idea to total return, then you've got to reinvest.
Yeah.
But that's happened if you're in a growth stock and you're not collecting anything from it, but it's growing internally at 10%. I mean, you're still, either way, you're reinvesting your growth. Now, with an income factory portfolio, if you want to grow it, you pretty much have to drip. You have to dividend reinvest either formally or informally, but you've got to do that every year. You don't have to reinvest in the same issues even, but you got to reinvest in something else to keep that growth going.
Okay.
But that is, your question was that's what I looked at. And so,
so the structure of the portfolio, like what kind of things would you put in there?
Yeah, typically, and then I have model portfolios, and I publish my own personal portfolio, at least how I'm allocated. And it's pretty much, I'll have credit. In fact, currently I've got about 2/3 credit and 1/3 equity. And the credit components would be high yield bond funds. I use a lot of closed-end funds, one, because a lot of these are less liquid asset classes. And I don't care about the liquidity so much because I'm in it for I'm making long-term investments.
Yeah.
But you don't want to be subject to the run on the fund sort of risk. If your assets start to become unpopular, and then the fund, if it's a typical mutual fund, there was a Third Avenue fund that had this problem a few years ago that was invested in fallen angels and stuff that was pretty risky, but they had it in an open-end mutual fund, and they ended up in a bad situation where they were forced to sell because of redemptions. With a closed-end fund, you don't have that. So closed-end funds are great for holding senior loans, and so I own senior loan funds, which have floating rates, which either of these can be a challenge or an advantage at different times. And then high yield bonds, which of course are fixed rate, shorter term than a longer bond, 5, 6, 8 years, and often run by really some of the best high yield bond funds I know are run by Mass Mutual, or Barings is the name they bought when Barings went bust so many years ago. But you've got a lot of really top-notch institutions that have been doing credit for years that run funds. And that, to me, that's a big part of my analysis, so to speak, in that I know they're going to have good years and bad years, but if they're people who've been doing this for dozens of years or generations, I know they're not going to do anything so stupid,
One would hope, Steve, right? There's no guarantee, though.
Anyway, high yield bond funds, senior loan funds, business development companies, which have been taking they've been getting horrible press for no particular reason lately, and they're way down. But there's some great. Business development companies are essentially, they're like mini banks, although they're only leveraged at the most 2-to-1 instead of 10-to-1 like a regular bank. Right. And they mostly invest in smaller, mid-sized companies. And the interesting thing is they're typically run by really top-notch outfits. I said Barings runs one BDC, Barings BDC. You've got Carlyle and Bain Capital and Apollo and KKR. There are a lot of really top-notch outfits that run billions of dollars that have BDCs. So they're non-bank corporate lenders. So they fit under that category of private credit that we hear a lot about these days, and which can be a problem or it can be an advantage. I see private credit as something really positive because what they've done, and there's a guy named, I don't know, over at Churchill, Randy Schwimmer, who's number 2 over there, put out a piece in his something called the Lead Left that he publishes every week, I guess.
Okay.
But pointing out that private credit actually is probably better structured and secured deals than in the typical large bank market, the so-called broadly syndicated loan market, the JP Morgans and all those. When you think about it, because private credit is you're designing the deal, constructing the deal for you to hold it.
Right.
So you're going to own it for 5 or 10 years. You've got a vested interest in making sure it's well structured and that the collateral works and that you've got a good relationship with the borrower and everything else. And so a lot of these BDCs they have good relationships with their parents, who often have great relationships with the private equity community. So they're designing and constructing deals for themselves to hold until maturity.
What's the BDC? That stands for Business Development Company?
Business Development Companies, yeah.
And so what's the structure is that in a fund structure, or how do you actually get access to something like that?
Well, they're sold publicly.
Got it.
So you can go if you Google BDCs, there are a whole bunch there are probably dozens of BDCs out there.
Yeah. Okay.
But they've been getting criticized lately, and their prices have gone down on a lot of really top flight, well managed BDCs, in part because they do make floating rate loans. So as rates come down, the dividends will drop a little. But most lenders considered floating rates for years an advantage, because if you're doing fixed rate loans and you're stuck with a rate that you're set here and 10 years later rates have gone up, you'd much rather have a floating rate, frankly, where at least you're continuing to get a solid, and you don't have to worry about the value of your debt going down because the rate's so low compared to the market rates. But anyway, so much for BDCs. They've got a vested interest, whereas broadly syndicated loans, when JP Morgan or whoever does $1 billion loan and syndicates it out, they're working for the fee. I mean, they may keep a small piece of it themselves, but they're primarily structuring deals to move them through their shop and sell them, and they make their money on the fee. So they don't I'm not saying their deals are poorly structured or the collateral doesn't work, but in general, despite some of the criticism and articles I've been reading in recent weeks and months about, BDCs, they do private credit and private credit's got issues, which it doesn't actually.
Yeah.
But they have more of an incentive to structure their deals because they're going to be holding them themselves and in a smaller group of people like themselves than a large bank syndication, which is sold off and they don't really see it.
Always better when our incentives are all in alignment, I would say, right? Steven, it strikes me as you're describing this sort of approach, this income approach. I think a lot of investors run into trouble with, sort of trading equities, high turnover, right? You sort of turn things over, you're over trading. This seems like a very low turnover strategy, right? It's a long-term play. You're looking to generate income over time. But at some point, I would imagine you would see reasons to make changes in the portfolio. Can you give an example of what would cause you to make a change in the portfolio?
Right. I differentiate a lot between trying to decide when to enter and leave the market.
Sure.
Which people do, where getting out of the market because you think it's too high or trying to get back in at just the right time, that leaves the big risk, I call it. You get off the train and then the train pulls back out of the station and you're not on it. And there's no conductor saying, hey, the market's about to take off, get on the train. And you look at a lot of people over an investment career, and a lot of books written about this, but you miss 1 or 2 or 3 times over 40 years where you're on the platform and the train takes off again. And, you may take you years to ever catch up, if you do. But anyway, with my approach, I invest in funds. primarily.
Okay.
I hardly ever buy an individual stock
Okay.
of a company. And of course, with bonds, bonds are most of the bond market's designed for big time institutional investors who are investing 100,000 or 500,000 at a crack. So I invest in funds because I want the managers of the funds that I buy to be those kinds of institutional investors and that kind of experience.
Yeah.
But then I use the closed-end fund market a lot because then you can often buy at discounts. If you can you can buy at discounts where you're paying less than the net asset value. If you were buying ordinary mutual funds, you always buy and then redeem at the net asset value of the fund, which has certain advantages too. But with closed-end funds, funds often will sell down and be selling at a discount for some of the time, not all the time. But if you look at a lot of funds, if their net asset value line is flat, they'll be the discount or premium might be above and below that line over time. Yeah. So often you identify the kind of funds you like, and I said senior loans, high yield bonds, BDCs, and then there are other more esoteric types of fund. I also buy higher yielding like utilities, stocks.
Okay.
And then there are funds that buy CLOs now, which get a little complex and risky for some people. CLOs they were a great asset class for decades for institutional investors. Yeah. And the CLO in the closed-end fund wrapper that they've now been put in by a few people, you got to be careful. Some of I don't want to criticize, but some of the managers of some of the CLO closed-end funds have they're collecting an awful lot of fees, probably a much higher percentage than they'd be collecting from institutional investors. So it comes out of the returns. So the returns on CLO funds have not been as attractive as for retail investors as they have been for institutions over time. But if you buy them at discounts at the right time, they're attractive. So
can you give an example of what would cause you to make a change in the portfolio? Would it be
yes.
a perceived greater risk or something new that comes about, or what would tell you, okay, this fund is no longer appropriate, I need to make a change?
Most of the changes, I identify maybe 10 funds within an asset class, say with the senior loan funds, and I may own 4 or 5 of them at any given time, but I'll watch them to the extent some of them go up to premiums, and I see other ones that are equally good funds, but they're selling at a discount. That might be this is generally in an IRA where I don't have to worry about tax consequences of trading and that. So I'd say an awful lot of closed-end fund investors do this, where they'll sort of have funds that they think on any given day, I'm happy to own either one. So if one's at a premium and I own it, I might sell it and buy the other one that's at a discount. And you see there's a certain amount of sort of swapping back and forth that some investors do. I have model portfolios, which to me are more like lists of candidates for my readers, my members of my group to kind of consider. I tell everybody, look, make sure you understand just because I put it up there and say this is my model portfolio, or I may own these, doesn't mean you should just rush out and do it. Do your own due diligence, make sure you understand it. But I'll give people hints about which ones I think are better bargains than others from month to month, often based on their relative discounts and premiums. Those are
So you mentioned your investing group on Seeking Alpha, which it turns out one of the most successful ones. Congrats on that. It's called Inside the Income Factory. What's your goal with that investing group? Is it educational? Is it to surface ideas? You mentioned a model portfolio. Like, what are you trying to accomplish with that group?
Well, I'm trying. I guess when I started it, I had written my book,
Yeah.
I have been writing articles on Seeking Alpha, just sort of ad hoc. You can write individual articles on Seeking Alpha, and you get paid as a blogger kind of based on the clicks, how many people read each article. But
Sure.
then some years ago, Seeking Alpha offered a service for writers who wanted to set up their own personalized subscription service. Seeking Alpha would host it, and that's what I did. But previously, I'd written articles, and I found as this philosophy of investing became more my own, and I'd be writing about my own experiences, it eventually just made sense to share it with others in a more formal way, and that's when I started the service. I'd say my goal is primarily to always it's to do a couple things. Provide information about how to do this for new subscribers, but most of my subscribers are people who've already, they maybe hear about me on something like your podcast, but
Sure.
I encourage many of them to, either read my book or they can go on Seeking Alpha, and there are certain chapters of my book that I put in that are available without even reading the book.
Right.
But you have to have access to Seeking Alpha for that.
Yep.
But then I also have anyone who subscribe. You can sign up to subscribe and get a 2-week free trial subscription, which a lot of people do. That allows people to see the model portfolios, read all my introductory materials, kind of get up to speed. And many people say, "Well, this is interesting, Steve, but it's not for me. I want to go after stock. I want to own stocks. I'm into, I don't blame them. A lot of people, stock investing can be fun and interesting, and even more fun if you're successful at it."
It's exactly
there
right.
are people, there are people that'll hear me. Like 10 years ago, when I'd write about this idea, I had people really calling me essentially a heretic. You're like, "Oh, you can't. Nobody can grow a portfolio over the long term without growth stocks." And I'd have to pull out show them, "Hey, no, here's the math."
Yeah.
And then one of the articles I wrote, it's a chapter in the book, but it's on Seeking Alpha. I'll send it to you if you wanted to post it for any of your readers to look at it. But I try to explain how traditionally income was what people looked at. If you go back and read Pride and Prejudice by Jane Austen, Mr. Darcy, the wealthy guy, they describe his wealth as he was worth £10,000 a year. In other words, his income. They didn't try to say, well, what his house was worth or anything.
Yeah, or his net worth or something, right?
That's right. It was always income. And until they launched 401ks and IRAs, and companies started to shift from providing pensions for their employees to making them their own pension managers. You'd put money in a 401k and then you'd roll it out. So, and I wrote an article about all this, and once we did that, once we became our own pension managers by having our own IRAs, then we needed the media and everybody to tell us how to invest. So everyone, have you ever noticed how CNBC is set up kind of like ESPN? All day long, you got a panel of people there, but instead of talking about sports, whatever the sports of the day is, they're talking about what's the Dow Jones and the S&P 500. What are the averages doing today? So it's always about what? The price.
Yep.
It's not about what kind of yield any of these things have, because you need.
And that's almost secondary, Steve. That often doesn't even come up, right? The income component to a lot.
Because how could you track it? In other words, they want people to get hooked on following the price of indices and about your own. And here are the 10 stocks that went up the most and the ones that dropped the most today.
Yeah.
Because that's all they can. I mean, I'm not knocking them, but it's a lot easier to get hooked on the price of something that you can easily show every hour on the hour, every 15 minutes, what it is. Following what an income factory does, generating 9, 10, 11% interest, and then it reinvests. That's like watching the grass grow. I mean, who would watch CNBC all day long to hear about, oh, well, yeah, these funds are generating 10% interest and you're going to get it once a month.
I don't know if that would get the viewers, Steve, but if it works, it works, right?
But it works.
It's funny when you're describing that. I mean, that whole, I feel like we're in this grand experiment as a society, going from defined benefit, where a pension fund is paying you a certain amount every month, to defined contribution, where you're basically, it's your job to create your own retirement. And arguably, I think what you're doing is great, because at least for me, reviewing your work has stretched my thinking quite a bit. Steven, one final question, and then we'll have to wrap it. But I'd love to know, because you wrote your book, The Income Factory, came out, I think 2020, right as the COVID era was starting. Yeah. I feel like that feels like about 20 years ago, not 5 years ago, because that was right before COVID.
That's right.
But I'm curious, the markets, and certainly it feels like the whole world, has changed quite a bit in those 5 years. I'm wondering if you write the book today, is it the same? Has the AI boom, the euphoria, the growth stock explosion, the over-concentration in benchmarks, does that affect how you think of what you're doing? Or is what you wrote in 2020 still very much relevant today? Or any tweaks to the formula, given how the world feels like it's changed so much?
Yeah, boy, that's a hard question, because my crystal ball is probably no better than yours. Probably not as
right.
big.
Yeah.
I mean, my whole philosophy is based, a lot of it is based on the idea that, I wrote a book actually called Too Greedy for Adam Smith about 10 years ago.
I saw that. About executive compensation and things
CEO compensation. I was 10 years before my time, but
I was gonna say, very relevant for today, Steve.
Yeah, because it's gotten far worse. But the point was, the people who run corporate America, or corporate world, but especially corporate America, have enormous skin in the game to keep it alive, to muddle through no matter what happens, whether it's political. I mean, who knows where we're headed politically or economically. Yeah. But when you're buying stocks, you're betting that two things will happen. That the corporate America, if you're buying the whole, the index, let's say, you're betting that corporate America will stay alive, and that it will grow, that it will, because your stock, if all the companies do is muddle through and stay alive, then at least investors in debt, corporate credit like me, I'll get paid.
Yeah.
But for stock investors to make their 9-10% on average for the rest of our lives, the companies not only have to stay alive, but they have to grow and thrive. Now, I feel, with all the challenges, and I said this 5 years ago, I mean, we had a lot of challenges back then with COVID and everything.
Sure.
And we had big challenges 15 years earlier, or whenever, with the great financial crash, whatever we call it.
Yeah.
And you know what? My kind of investors actually did pretty well in the great financial crash of years ago, because if you've got a portfolio of debt, bonds, stocks, bonds, loans, during these big crashes, the secondary market for healthy loans and bonds and everything still drops, sometimes to like 60, 70 cents on the dollar, like it did 18 years ago.
Yeah.
And if you stay the course and you collect in your loans, your bonds, and then you collected 100 cents on the dollar. Now you'll have some defaults, but defaults are you can project what default levels will be, and you get back 50 to 60 cents on the dollar anyway on most defaults. So if you collected 100 cents on the dollar and can reinvest in new healthy loans on the secondary market for 60, 70 cents on the dollar, you'll make out like a bandit later. You'll get a higher yield because your denominator is smaller. You haven't paid as much, but you're getting the same return, the same coupon. And later you'll collect 100 cents on the dollar for what you paid 60 or 70 for. So credit investors often do better than ever, like if they stay the course, and then in the years following the crash. So what you have to ask yourself is all the time, will it be worse this next time? In other words, at some point, maybe we're going to get that 1930s type depression where companies really do, stop paying debt, where you have so many bankruptcies and everything that even a credit sort of strategy won't work. But I have to keep telling myself I don't think that's going to happen. I mean, I think we're going to muddle through. I think corporate America will muddle through and figure out how to keep itself going, no matter what, pretty much.
Yeah.
That's what I'm betting on, with a strategy that bets more on interest and high yields than it does on growth. I mean,
Steven, this has been so fascinating. I really appreciate. I loved reviewing your work and looking through the book, because I think it stretched my thinking in terms of. I mean, again, I'm guilty as anyone else of focusing on capital appreciation and growth and price as the most important, if not the only thing I should be focused on. And your work provides a fantastic reminder that there are other areas to have some good returns, particularly during periods of market uncertainty. Next time you come on the show, we'll talk about your other book, Too Greedy for Adam Smith. We'll talk about Elon Musk, $1 trillion compensation packages and all that sort of stuff.
Yeah, there's a lot.
For now, I will say thank you for coming on the show, Steve. This has been a pleasure, and I look forward to keeping in touch with you.
Thank you, Dave. It's been a pleasure and a lot of fun, too.
I hope you enjoyed that interview with Steven Bavaria. Thanks again to Steve for joining us here on the show today. It's interesting, as I was listening and reflecting on my conversation with Steve, it's sort of a similar vibe that you get talking to someone who's big into real estate, having like rental properties, right? Where you're focusing less on the value of something growing and more about the consistent monthly or quarterly income that you get, the annual income you get by owning a property and getting those rental payments. Similar kind of idea with very different financial instruments, but really helpful for those of you that are less familiar with what syndicated loans are, what closed-end funds are, debt instruments and how they relate to equities that we think about. I thought that was really helpful to sort of, understand a little bit more about this style of investing. I was definitely intrigued, thinking about, not that I would make my entire portfolio an income factory, but certainly thinking about that income component to my portfolio as part of a total asset allocation, maybe thinking a little bit more about some of these alternative instruments, things that I would not normally put into a portfolio. Really appreciated the comments about how a consistent income stream can be very helpful in creating consistency in returns. And that's one thing that definitely hits home here in 2025. I don't know about you, but many investors here in 2025 have probably experienced some monster gains in the growth space, and that's great as long as they continue. But as Steve very rightfully pointed out, the bad thing about betting on capital appreciation, which is just the price of things going up, is they can go up a ton, but they can also come down a ton. And if we would get some tumultuous period where there's a big corrective move, a strategy like Steven's describing with the income factory approach should certainly, it's designed to give you more consistent returns and give you an opportunity to really outperform during that period of market dislocation. Great comments there and take by Steven Bavaria. We'll have links below to get more information about Steve's work and certainly to access his books, which I think were very, very well done. By the way, if you want to learn more about how we can actually analyze price, if you want to understand what price means and what this interplay between fear and greed as reflected by stock and ETF prices, how we can use them to better anticipate where opportunities may lie in the future, our Market Misbehavior Premium memberships may be a great opportunity for you to supercharge your own decision-making going forward. 3 great benefits to the premium membership. First off, access to all our virtual courses. We'll teach you all about technical analysis, behavioral finance, what happens between your ears, what tools and techniques you can use to better evaluate market conditions at any given point in any part of the cycle. Second benefit, we have member-only reports like our weekly flight plan, which is our main investment report we put out every weekend, our monthly chart review where we apply a proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our member community. This is a small but mighty group of like-minded investors learning about technical analysis, analyzing charts, sharing ideas, sharing questions. I'm in there every day answering questions from our premium members, and we'd love to have you join that community. You can find more information at marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for joining me here on the Market Misbehavior Podcast. Don't forget my daily market recap show called Chart This with Dave Keller. That runs every afternoon after the trading day on my YouTube channel called Market Misbehavior. For Market Misbehavior, I'm Dave Keller. Have a great one. And remember, it's always a good time to own good charts.